So, thank you back everyone. Our next session will be a keynote address, Building on Finance Theory to Forge the Future of Investment Practice by Bruce Jacobs, Principal and Co-Founder of Jacobs Levy Equity Management. Many thanks to Jacobs Levy Equity Management for their sponsorship of this event as well. Bruce.
Thank you, David, for the introduction. Welcome to everyone. Today, as David said, I'm going to talk about building on finance theory to forge the future of investment practice. So we'll start off with academic asset pricing theories, which are neoclassical and are parsimonious, and admittedly, they are elegant. And that's what attracted me to the field of finance. However, the real-world financial markets are complex. There are many different forces that impact prices. There are many different participants. And the real-world markets are quite dynamic as the economy evolves, as fundamentals evolve. And also, the real-world financial markets are behavioral because it's made up of the actions of human beings with their behavioral biases and their traits. So today what we'll talk about is bridging the gap between theory and practice. This will be a theme. And in particular, factor modeling and factor investing gave rise to smart beta and now to smart alpha. And MPT, which we've talked a lot about today, doesn't actually take into account leverage risk. And we'll talk about how we built in investor aversion to leverage risk in the MPT model. We'll also talk about enhanced active equity long-short extension strategies, which are an improvement over long-only approaches. And we'll talk about, as an alternative to modeling with continuous time finance, to simulate financial markets. So we'll start off with modern finance theory, which blossomed in the 50s, the 60s, and the 70s. Models we're all familiar with. Modern portfolio theory, Markowitz, 1952. Capital asset pricing model, Sharpe, 1964. Efficient market hypothesis, Fama, 1970. Option pricing model, Black and Scholes and Merton, 1973. Arbitrage pricing theory, Ross, 1976. The assumptions that are made on these models are that the markets are informationally efficient. They digest information rapidly and correctly. Hence, prices are rational, and prices are always at or near equilibrium. Investor behavior is not considered at all in these models, and market anomalies do not exist at all. So we'll start off focusing on factor models in particular, asset pricing factor models, the most well-known being Fama and French's 3 and 5 factor models, 1993, 2015, and Carhart's 4 factor model, 1997, and Ho, Shui, and Zhang's factor model, 2015, is a more recent example. And another more recent example is Daniel Hirschleifer and Sons factor model, 2020. Factor investing gave rise to smart beta products. Factors, however, may perform poorly for extended periods of time. So we need to be cautious when we apply academic research to investment practice. And we've recently written an article which will appear in the January issue of the journal Portfolio Management and is up on the PMR site at this current time. Successful investment practice requires adapting and enhancing research methodologies to explain the complex, dynamic, and real-world markets. Let's talk about parsimony some more versus complexity. we've said that academic factor models are parsimonious. The stock market is indeed a complex system. In fact, the first article we submitted to the journal Portfolio Management, to Peter and Frank, was an article that was published in 1989 called The Complexity of the Stock Market. When you model markets, you need to balance the potential underfitting with potential overfitting of the data. Now, these academic models, which have just a few factors in them, underfit the data, and as you add more and more factors, you might possibly end up overfitting the data, which means you're fitting not only signal, but also noise, which may not replicate going forward. We all know that more and more factors have been identified over time. In fact, when Ken and I went off and created our firm, one of our goals was to model as many factors as we could, which was not traditional back in the day. Instead, most of the studies of anomalies, which were just beginning to appear, were looking at one anomaly at a time, sometimes two anomalies at a time to see which one really mattered, sometimes three anomalies at a time, but never the whole group of anomalies that had been uncovered. That was our idea, actually, when we created our firm, which was to spend full time researching all the known anomalies. And we did so in a unified framework with simultaneous research. We looked at 25 anomalies simultaneously. This way, we could disentangle one anomaly, or today called factor, from another, so we would know which anomalies mattered and which anomalies didn't matter. We published an article called Disentangling Equity Return Regularities, New Insights and Investment Opportunities. And that was helpful elucidating our philosophy to help our investment hopes get underway. Additional studies have been done, of course, looking at multiple anomalies. These include Harvey, Liu, and Zhu, 2016, Green, Hand, and Yang, 2017. Let's talk some more about parsimony versus complexity, specifically the parsimonious academic factor models. We know that factor performance has been inconsistent. And I mentioned we have this article that's forthcoming in the JPM. Let's take a close look at the Fama-French factors. Fama-French modeling, of course, is the most widely known, frequently referenced in academic literature. They developed both a 3-factor model and many years later a 5-factor model. In their model, there's a market factor, but we'll focus here on their small minus big and high minus low, panels A and B in the upper part of the exhibit. So let's focus on the top left chart, small minus big, capitalization. You'll see there's a vertical line. That's when the size effect was first reported in the literature. Now, you know there's often studies showing that after a factor has been revealed, it will no longer work. Now, you'll see that small minus big didn't work for some time after it was first reported. Later, Fama and French created the 3-factor model and included the small minus big factor. You can see after it was included, it didn't work. Then it began to work, then it leveled out. So it hasn't provided much excess return. In panel B, the upper right-hand side, we have high minus low book to price. You can see before it was first published, the first vertical line, it provided an opportunity. Didn't provide much opportunity after that. Fama and French included in their 3-factor model. It provided some opportunity, had a downdraft, provided some opportunity, and hasn't done much since then. So since it was included in the Fama-French model, it hasn't provided much premium. Many years later, Fama and French created the five-factor model, which we found to be an interesting development, that we're moving towards more complexity from simplicity. The factor they decided to include was robust minus weak profitability. You can see it worked very well up to the time it was first published. After it was included in the Fama-French five-factor model, it continued to work. Now let's look at panel D, conservative minus aggressive investment. Again, working well until the time of discovery and publication, then not providing much premium, then included in the Fama-French model and not providing much premium. So we can see that these generic factors that are used in a small simplistic scale sense in a 3 and 5 factor model have provided very variable performance and have had extended periods of underperformance. Now let's compare that to a different approach that we call Smart Alpha, which is an active, dynamic, multi-factor approach. Here we assume the market is multidimensional. There are many factors that matter. Some of them are fundamental, and some of them are behavioral. Of course, this is a follow-on to our 1988 disentangling paper, but we also wrote 2 papers on this topic. The first one is Smart Alpha versus Smart Beta, and the second one is investing in a multidimensional market. And by the way, these references are all in our paper, which appeared in this 50th anniversary issue of the Journal Portfolio Management that you all have. So in a disentangled framework, we use a cross-sectional approach to factor modeling. One of the benefits is this allows for many factors because there are many degrees of freedom. If you're monitoring the US markets or other markets, there's a large number of institutionally investable securities, certainly over 3,000 in the US. And by using a cross-sectional approach, we are disentangling, so we're controlling for the correlations with all other factors. By disentangling, we're measuring the unique contribution of each factor. Now let's consider different investment designs, a static versus a dynamic design. So typically, Smart Beta is run in a more static fashion. There may be exceptions to this, but this seems to be the norm, or at least at the outset of Smart Beta. It's very much a rules-based approach with a few targeted factors, which are well-known factors, known to the marketplace. And we've seen that Smart Beta is vulnerable to changing market conditions. On the other hand, let's discuss a different type of investment design, a dynamic one, which we call Smart Alpha, where one is disentangling factor returns cross-sectionally. One can use time series analysis to forecast returns to each factor. And one can consider market and economic conditions for a more dynamic approach. We wrote a paper in 1989 called Forecasting the Size Effect that anticipates the performance of small versus large in a disentangled framework to economic conditions. And in this type of disentangled framework where you could have many factors, you can do a lot of proprietary research, come up with your own proprietary signals, and build them in. And after all, isn't active management all about having an informational edge? You need unique insights. Would you really expect that a simple model using generic well-known factors would produce consistent value added? a better opportunity if you can create an informational edge, as that's always what investing has been about. Now let's talk about time series versus cross-sectional in greater detail. So smart beta is typically relying on those academic factor models, which are typically, in the Fama-French style, time series models. So they are parsimonious time series models based on factor portfolio sorts. Sorts, I mean small versus large, high versus low, book to price, doing that sorting. On the other hand, Smart Alpha is a cross-sectional approach based on multiple firm characteristics. As I mentioned, our 1988 paper talked about disentangling in a cross-sectional fashion, and a more recent example is Llewellyn 2015. If you disentangle, you can build a multi-dimensional portfolio where each one of those dimensions is a proprietary factor. That can provide for diversification, the first principle of finance, across numerous factors, and can provide for dynamic portfolios that has evolving characteristics to evolve with economic and market conditions. Let's talk about some additional advantages of the cross-sectional approach. Cross-sectional factors have higher explanatory power for average returns than models using time series factors. That's an important point. Well, we said as much in 1988, and Fama-French in 2020 came to the same conclusion. Now, let's consider some of the other potential drawbacks of time series factors because they're often constructed in an ad hoc fashion. The number of portfolio groups and the breakpoints chosen are arbitrary and ad hoc. Remember, I spoke about portfolio sorts. Well, you determine groups and breakpoints for high versus low. And each time series factor sort unavoidably captures return effects from other factors because they're not disentangled. However, cross-sectional factors are optimally constructed. Cross-sectional factors resulting from the regressions of returns on pre-specified characteristics are optimal. Cross-sectional regression disentangles other return effects and provides pure returns to each factor, which is a term that we suggested in our disentangling article. I refer here again to our disentangling article and to our 1989 article, Forecasting the Size Effect, where we used economic conditions. Let's continue on with some additional advantages. The time series approach is more widely used for portfolio evaluation, for portfolios as opposed to securities. And factor exposures in time series are stationary over a fixed period. However, a cross-sectional approach is readily applicable to individual stock valuation, which is what many of us are interested in. You can capture the evolution of characteristics for each individual firm with time-varying factor exposures. And you can create an informational edge with proprietary research, unique insights, an informational edge, so that you can outperform your benchmark. Now we'll turn to a different topic, which is modern portfolio theory and incorporating leverage risk into MPT. So MPT uses, as most of us in the room know, mean variance optimization. However, there's no consideration of the risks and costs of margin calls and the possibility of having losses that exceed your capital and the possibility of bankruptcy and the possibility of being forced to liquidate at adverse prices upon receiving a margin call. That would seem to be an important consideration. Why is this? It's because modern portfolio theory assumes a proportional or linear increase in portfolio volatility with portfolio leverage. That is, it assumes there's no nonlinearity, it assumes there are no margin calls. In fact, in Kroll, Levy, and Markowitz, 1984, they said the following: leverage increases the risk of the portfolio. If the investor borrows part of the funds invested in the risky portfolio, then the fluctuations of the return on these leveraged portfolios will be proportionately greater. Again, no room for margin calls, no consideration of margin calls, no consideration of the risk of leverage or investor aversion to leverage risk. Yet, we are probably all in this room familiar with what happened to long-term capital management, where they had leverage of 25 to 1 that ballooned to 10 times as much and took them under because of margin calls. So margin calls are an important consideration. The volatility risk does not increase proportionately with leverage because there can be unique events where you're running out of capital. So what is the traditional solution? MPT must have a solution to this, and that's to use a leverage constraint. But using a leverage constraint on the optimization problem is unlikely to lead to the portfolio offering the highest utility. You can find the optimal portfolio for any given level of leverage constraint, but which level of leverage constraint is optimal? So the preferred solution, as with any economic problem, is to balance the economic trade-offs between expected portfolio return, portfolio volatility, and portfolio leverage risk. Indeed, investors, I think all of us in this room, are leverage averse. If you consider two portfolios, and if I tell you they both have the same expected return and the same standard deviation, you would tell me you're indifferent as to which portfolio is preferred. But now, if I tell you that one of those portfolios has leverage in it, and the other one achieves that expected return and standard deviation without any leverage, I think you would tell me, I'll take the one that has no leverage and gives me the same expected return and standard deviation, because it has no margin call risk. But MPT cannot distinguish between those two portfolios. So what Ken and I did is we added to the MPT utility function a term that captures aversion to the unique risks of leverage. We wrote a series of articles on this, and we state in the article we have in the current 50th anniversary issue the following: the mean variance leverage, or MVL model, is an approach that allows investors to determine the right amount of portfolio leverage with the right kind of diversification, taking into account an investor's volatility aversion and aversion to the unique risks of leverage. Now let's move on to another topic which is related to MVL, which is enhanced active equity long-short, often known as extension strategies, which can improve the efficient frontier. This is an application of the MVL utility function to such an enhanced active equity long-short portfolio structure, which for those who are less familiar would be a 1-30-30 type structure, where for every $100 of capital, you'll have $130 long and $30 short for a net position of 100 so that you can have a beta of 1, track the benchmark, and add value with incremental longs and incremental short positions that allow you to underweight securities that you couldn't otherwise underweight in a long-only assignment because they're very small proportions of the benchmark index. And if you don't hold the name, you might only be underweight a basis point or 2 basis points. Now, we said in an article in 1998, this article is called On the Optimality of Long-Short Strategies, the following. The important question is not how one should allocate capital between a long-only portfolio and a market-neutral long-short portfolio, but rather how one should blend active positions long and short with a benchmark security in an integrated optimization. However, this was prior to, as Joanne Hill would know well, prior to the availability of prime brokerage structures that made this feasible for institutional investors. Now let's take a look at the efficient frontiers for various leverage tolerance cases using the MVL utility function. So the lowest frontier here is what we could call the Markowitz frontier, because that's where your leverage tolerance is 0, and that's where the mean variance model works perfectly well. You have no leverage tolerance, you'll take on no leverage, no shorts, no incremental long positions. And so that frontier represents different long-only portfolios. The higher frontiers allow some leverage because the leverage tolerance levels grow to 0.5, 1.0, 1.5, 2.0, i.e. that investor has the ability to take on some leverage, has some tolerance for leverage risk. You get a higher efficient frontier because you have incremental longs working for you. You have short positions working for you as well. Now let's take a look at portfolios A, B, and C. Now instantly, from everything we've learned from modern portfolio theory, you might say portfolio B is preferred to A because it can obtain a higher expected return at the same level of standard deviation. Or portfolio C is preferred to A because it can obtain the same expected return at a lower level of standard deviation. However, in an MVL model, that's not correct, because if you're an investor with a leverage tolerance of 1, you will prefer portfolio A over portfolio B or over portfolio C, because all the efficient portfolios are shown for the investor with a leverage tolerance of 1. In order to prefer portfolio B or C, you would need a leverage tolerance of 2. So the bottom line is portfolios B and C entail more leverage than the investor who has a leverage tolerance of 1 is comfortable with. That investor doesn't want to take on the leverage associated with portfolio B or C because of the potential for leverage risk, what we call the unique risks of leverage, because of the possibility, say, of a margin call. Although if you run 130-30 portfolios, you're not too leveraged, so the likelihood is less, but some might want to run a 175-75 portfolio, of course. Then the risk of a margin call grows. Now let's take a look at efficient frontiers for various leverage and volatility tolerance cases. So this is similar to the prior exhibit, except it also maps out efficient frontiers for different levels of volatility tolerance, which are the more vertical colored curves. Something that may be of interest, which we've talked a bit about, is as the investor's leverage tolerance becomes less, you shift downward in the frontier opportunities. And as the volatility tolerance becomes less, you shift leftward and downward in terms of the opportunities until you ultimately reach the origin 0, 0, which, just to make clear what that is, it's the point at which the standard deviation of active return is 0 and the expected active return is 0. So that is the index fund. Now that we're in a three-dimensional MVL space, we can map out an efficient surface. That's what you see here, where on the X and Y axis you have volatility tolerance and leverage tolerance. And on the vertical or Z axis you have the enhancement. This is your full opportunity set. Where you lie here on the sufficient surface depends upon your volatility tolerance and your leverage tolerance. Now, if you have a volatility tolerance of 1 and a leverage tolerance of 1, the ideal portfolio is a portfolio labeled as portfolio G. And that is at approximately a 130-30 portfolio. So the enhancement is 30%. The amount of leverage, because of the incremental longs and shorts, is 60%. Now let's move on to another topic, which is simulating financial markets to represent real-world markets. Many market models use continuous time methods. And a prime example of that is the Black-Scholes-Merton option pricing model that we're all very familiar with. And it has simplifying assumptions that the underlying security price process is fixed and that prices change randomly and continuously over time. One beautiful aspect of continuous time finance is it can be solved analytically. However, continuous time finance is not useful when the investment actions or changes in the underlying environment alter the price process. And it's not useful as to whether theories about the behavior of investors can explain the observed phenomena of the market. So Ken and I and Harry Markowitz banded together. Harry, as you know, is well known in the simulation world, to create the Jacobs-Levy-Markowitz Market Simulator, or for short, JLM Sim. It is an asynchronous, discrete time, dynamic market simulator. You can model the evolution of market prices and trading volumes over time. Price changes will reflect events which unfold in an irregular fashion. The price process is a result of simulated market participants trading with one another to maximize their individual utility functions as conditions change. We wrote about this in 2 articles. Examples are the stock market crash on October 19, 1987. You may recall the option replication portfolio insurers who engaged in a positive feedback trading strategy caused an avalanche of selling on that day. And we've written extensively about that. Asynchronous models like JLM Sim could explain both the abundance of sellers and the dearth of buyers. We can show that a relatively small proportion of momentum investors can destabilize markets, overwhelming value investors who seek out bargains. Flash crashes can result when traders do not anchor their bid or offer prices to existing market prices. Now we can also use JLM Sim in a capital market equilibrium mode. Many of us are familiar with reverse optimization, a procedure to find equilibrium expected security returns, Black and Luderman, 1992. However, this utilizes CAPM assumptions that investors can borrow without limit at the risk-free rate and short securities without limit. Here, the separation theorem applies, and all investor portfolios lie on the straight capital market line, or CML, Tobin, 1958. However, investors can neither borrow without limit at the risk-free rate, nor short securities without limit. Investor portfolios do not all lie on the capital market line. Instead, there's a curved efficient frontier, and the compositions of the portfolios of risky securities will differ individual by individual. JOM SIM can solve for expected returns for markets in which investors cannot borrow or have restricted borrowing, and in which investors can or cannot short. So in conclusion, we've considered academic research on asset pricing, which has a neoclassical view, often with unrealistic assumptions of rational investors and no market frictions, with rational prices and at or near equilibrium prices, and the models are, in our view, overly simplistic to represent real-world markets. Real-world markets are far more complex. We've considered factor models, academic models, which are parsimonious, such as the products that derive from them, smart beta with a few generic well-known factors. We've talked about smart alpha, which is an active, dynamic, multi-factor approach with a wide range of factors and changing market conditions, and can use proprietary signals. We've talked about leverage risk as well, that leverage entails a unique set of risks, the risk of margin calls and possible bankruptcy, and MPT fails to account for these unique risks. Mean variance analysis per MPT will not result in optimal portfolios for leverage-averse investors because MPT doesn't take into account leverage risk or investor leverage aversion. Our MVL model extends MPT to account for investor aversion to leverage risk, so we can solve for optimal portfolios in the face of both volatility and the risk of leverage. We've discussed enhanced active equity long-short extension strategies, which provide for improved efficient frontiers compared to long-only efficient frontiers, and can result in improved portfolio efficiency for 130-30 type portfolios compared to long-only portfolios because of the incremental long and short positions which permit you to underweight names that you couldn't otherwise underweight in a long-only assignment. We've talked about financial market simulation and that continuous time models are not appropriate for behavioral markets, and that an asynchronous discrete time dynamic simulation is more realistic, as per JLM Sim as one example. So investment managers, in our opinion, need to modify academic models to better reflect the real world if they are to succeed in practice. Striking the right balance between simplicity and complexity is key, and adapting strategies to changing economic and market conditions is important. And doing proprietary research to obtain an informational edge with unique insights so that you can outperform benchmarks is critical. So on the occasion of the 50th anniversary of the Journal of Portfolio Management, we thank the journal for publishing useful research that directly addresses problems faced by practitioners. Thank you very much.